Okay, welcome back to page 10, chapter 5, and section D. So, remember I said that in the parents' books, they have a little T account for investment in the sub, or just investment. And they can use the cost method, where you just put the cost, leave it alone. Or we're going to have the equity method. Okay, so with the equity method investment, if you remember from chapter 2, we make a purchase at cost, but then when our sub declares net income, we take a portion of it, 80% in this case. Well, yes, 80%, sorry, we aren't there yet. Or whatever percent, and then the dividends decrease it. Okay? And we don't put it to fair value or anything. It's just the purchase, and then every year we do net income dividends, net income dividends of the subs that they give to us and their net income. Or net loss. If it was net loss, it would be over here. Okay, net loss would be a credit, because this is an investment account, an asset. Okay, so let's think about what's going to show up on the parent's income statement then. Is there any dividend income? Well, no, because we would credit the investment in cash. So we debit cash. Be careful, some questions. Dividend receivable. If they've declared the dividend, then it's a receivable, but we still record it. Because remember, the minute they declare it, it becomes an active liability for them, so it'll become a receivable for us. Dividend receivable, and we credit dividend income? No, that's for cost. But here we do investment. So are either of those income statement accounts? No. So there's going to be no dividend income in the parent's income statement. Okay? Instead, they'll use equity method income for recognizing, sorry, I made this too small. So instead, let's see, no, that won't help because it won't go here. Okay, so instead, equity method income for recognizing net income in the subs. Okay, so that's the account we're looking for. So this is it's called a one-line consolidation method, one-line consolidation, because it'll end up with this. Consolidated net income attributable to the parent. So remember, we have consolidated net income, and that there will be parent and NCI. They're talking about the parent. Will always be equal to the parent's net income reported in its internal records for that year. Right? Because how did we adjust the parent's net income with consolidated net income? Well, this is on page 9. About the parent minus the dividend from the sub. Well, there's going to be no dividend stuff in there, so we don't need to worry about it. Then we added subs adjusted net income. And are we going to have that in there? Because for this one, we're going to debit the investment and credit equity method income. Let's just write this one down. Just to remind you, debit investment, credit equity method income. Okay? So we're actually going to add the subs net income here. Our portion of it, right? Because we only take 80%. Now you might be wondering, well, the equity method didn't do anything like this. We're going to add on to the equity method. Way back in chapter 2, I said we're going to learn this every chapter. So each chapter we go through, 5, 6, 7, and 9, we're going to add new entries in. Okay? So when we do the parents' netting, because we're doing this on the books, notice these are on the parents' books. The parents' net income will be adjusted in its internal records so it'll match our little calculation we did. Consolidated retained earnings are always equal to the parents' retained earnings for the same reason. If you're using the equity method, you're going to keep making these adjustments year after year. So here, we keep changing our retained earnings because we're making the equity increase, and we still have to take this away, and we do this. So it'll all work out. Now, what people don't like about it is it's all the entries. Every time you do another adjustment for changes in AD or something like that, or all the chapter 6 changes we're going to do, there's another entry for the equity method. Whereas the cost, you just enter debit investment, credit cash, and you just let it sit there unless it's impaired. Okay? So don't worry, we're going to go through an example so you can see how it works. So we're going to use example 1 from earlier, but this is called 2 for the equity method. So all the same, just read it through again. Put it on pause if you need to. And we're going to do year 5 and year 6. Okay. So in year 5, the sub reported a net income 100, paid a cash dividend 25. Okay, we know all this, impairment test. Oh, we've got all this done. So when you're doing these equity method entries, you also have to know how to do the schedules like G and stuff. Okay? So what I want to do is complete the journal entries required by the parent for each year and calculate the parent's portion of consolidated net income. Okay, so remember, first thing you do is you got to record the purchase. January 1st, year 5 was the purchase. Yeah, and I'm putting stars beside this. You have to know these or have them tabbed. So we're going to debit. For how much did we pay? Did it say on page 10? $27,200. And credit cash. And remember, we're doing the equity method entry. So, reminder, cost method stops here. So, let's go to December 31st, year 5, and now you already know the 2 main ones we have to do. We have to record the subs net income or net loss. So, did they have net income or net loss? You can just look up at the top. You don't have to go back. Oh, they had net income. Okay. So we're going to debit. What are we going to debit again? Cash? No, investment. Because net income's going up, so the investment's getting better. And we're going to credit equity method income. Now, do we put the full 7,300? Nope. Times 0.8, that's 5840. Okay. Now, besides net income, what's the other thing we do that we did in chapter 2? Dividends. Subs, dividends. So what's physically happening? They're either paying dividends or they've declared, in which case it's a receivable. In this case, they just said they paid, I think, paid a cash dividend. Yes, so we got cash. And do I credit investment income? No, investment. We don't get the full amount, we get 2,500 times 0.8, which is 2,000. Okay, so those are from chapter 2, and you should know them. Now we're going to add a new one. I'll put it in another color. We need to adjust for changes in AD year 5. Okay, so let's find out where our schedule is. It's on page 8. So, we just want year 5 because you do these every year. So year 5 only. So if you're doing it for year 9, you do year 9 only. Okay, so year 5. We've got negative 350. So I'm confused. Is net income going up or down for this? Let's just review this, you guys, because this messes people up. So inventory is sold. We're making cost of goods sold go up, which means net income goes down. So if it's negative, net income's going. Patent, we've got impairment or amortization. So net income is going down. Goodwill is impairment. Net income is going down. Okay? So all three of them, net income's going down. So let's put that down. We know net income's going down for all three, so we can just sum them up. You can always just sum them up. You guys just make sure you pay attention for the sign. Okay, so is that going to be good or bad for our investment? You are always, except for this dividend one, which is an anomaly, you are always going to use, on the equity method, these two accounts. So it's only these two accounts except for the sub, dividend. Okay, so this is different accounts. But everything else is the same. Do you think investment's going to go up or down if net income's going down? Well, it goes up, so it's a debit, so it must go down. And what are we going to debit? It's not cash. What's our other account? Should we put impairment? No. We always use the same account. You will see these accounts flip-flopped through all the transactions we do in 6 and 7. Okay? So if it says sales or something weird, which we're going to learn in chapter 6, I don't care. You use these same two accounts over and over and over and over and over and over for the equity method, except for dividends. So we're going to debit equity method income, so it's like an expense. It's going to be 3,550 times 0.8, so 2,840. Okay, so see the equity method income T account. Okay, so you're done there. Equity method income little T account. Well, we start with 5840 credit. We're increasing net income. And then we debit it sorry, wrong one. 2840. Which means you've got 3,000, which net income is going up because it's a credit. Okay? So now, let's look at the parent's income statement under the equity method. So, we're going to take the parent net income with no dividends, because we can't use the one on page, oh my god, page 8? Yes. Why can't we use this net income here on page 8? This 21.4. Because it has dividend income in it, and it doesn't have equity method income. So we can't use that equity method. So we can go parents' income, no dividends, and you can take it off there. You can do 21,400 minus 2,400. Minus